Hello everyone and welcome to Zalwora. You see those little memory chips in your computer? Turns out they are the new gold rush. This is the chart for Micron Technology, ticker MU. Micron, the memory giant, just blew away expectations with their latest earnings report. Their revenue shot up a massive 46% year over year. Since January 2024, the price has exploded, delivering a jaw-dropping 90.5% return. But here's the million-dollar question. Is this just another one of those volatile cyclical spikes we've seen in memory chips before? Is it going to crash? Or is something fundamental, something structural happening this time? We believe Micron is no longer the company you remember. It has transformed into the single most critical non-Korean supplier in the world's fastest growing component market, AI memory. This is the story of how Micron became the AI memory king. To understand the conviction behind this 80% rally, we have to look beyond the surface. We need to check the technical structure. Micron stock is currently trading at around $156, near its all-time high of $170.45. But what's fascinating is its relationship to the moving averages. The price sits above the 20-day MA at $145, confirming strong short-term momentum. It's above the 50-day MA at $127, confirming a solid medium-term trend. But the most important number is the 200-day moving average, which is way down at $14.42. That massive sustained gap between the current price and the 200-day MA is technical proof that the market has abandoned the old cyclical valuation model. This isn't just a temporary boost. This distance suggests large fundamental investors are locked in, betting on a long-term structural change. And look at the volume. Average daily volume has shot up to 31.2 million shares in the last 10 days, up significantly from the baseline of 22.5 million. When high volume coincides with rising prices, that's the signal of institutional conviction, big money moving in. The technical story is validated by the financial story. Micron's fiscal Q4 2025 earnings didn't just meet expectations, they created a financial earthquake. They reported a record $11.32 billion in revenue. The full-year earnings per share saw a monumental jump of 538% year over year. That is a powerful, definitive end to the recent industry downturn. But the real jaw-dropper is their forecast for Q1 2026. Micron is guiding for gross margins to exceed 50%. Think about that. In the commodity memory business, 50% margins are almost unheard of. This level of profitability is enabled by one thing: technological exclusivity and overwhelming demand. It fundamentally changes Micron's risk profile, giving them a huge financial cushion. What is driving those unbelievable margins? It's not your laptop memory, it's high bandwidth memory or HBM. HBM chips are essentially memory stacks that are bonded directly onto the main processor, allowing data to be processed incredibly fast. They are non-negotiable for training the biggest AI models. The global HBM market is poised for hypergrowth. It's expected to nearly double from $18 billion in 2024 to $35 billion in 2025. That means massive, guaranteed capacity uptake. Micron's HBM business is already flying. Q4 HBM revenue hit nearly $2 billion, implying an annualized run rate of $8 billion. This segment is the profitability accelerator because HBM commands an average selling price that is nearly 4 times higher than traditional DRAM. Every HBM sale Micron makes structurally improves their entire corporate margin. They are investing heavily, $13.8 billion in capital expenditure in fiscal 2025. But it's all focused on expanding HBM capacity, ensuring those 50% plus margins for years to come. The competitive landscape is defined by three players: SK Hynix, Samsung, and Micron. Micron's first major move was becoming the sole HBM3E supplier for specific NVIDIA H200 GPUs. That win alone established Micron as a critical, high volume strategic partner to the world's AI leader. Now the focus has entirely shifted to the next generation, HBM4. Micron's strategy has been aggressive. They skipped HBM3 and focused entirely on perfecting HBM3E and HBM4. Micron is now shipping HBM4 samples achieving industry-leading speeds of 11 gigabits per second. This speed reportedly matches Samsung and, crucially, surpasses SK Hynix's stated capability. This immediately makes the HBM4 race a three-way, head-to-head technological sprint. Micron's goal is clear. They aim to boost their HBM market share from around 5% to 20 to 25% by 2025. Their target for HBM4 mass production is Q2 2026, perfectly timed for NVIDIA's next platform, Rubin. Execution is key, and so far Micron has proven they can deliver. After this incredible run, the biggest question is the stock expensive? We use a concept called growth at a reasonable price, or GARP. The trailing 12-month PEG ratio stands at an astonishingly low 0.56. A PEG ratio below 1.0 is the classic signal that the market hasn't fully priced in the future growth. It means you are still acquiring this tremendous growth story. Remember the 538% EPS jump? At a discount. Now let's look at the PE ratio. The estimated forward PE is 9.64 times, which is extremely attractive compared to its peers. If we look at the current PE of 20.88, it's only a modest 13% premium over its 10-year historical average. Why is this premium so small? Because the market is still skeptical, clinging to that old cyclical reputation. But that skepticism is your opportunity. The premium is entirely justified by the structural shift to 50% plus gross margins driven by HBM. The old average is irrelevant when you have a 4 times higher ASP product mix dominating your revenue. The valuation thesis is fundamentally sound. But don't just take our word for it. Wall Street maintains an overwhelmingly positive sentiment, a strong buy consensus from 32 analysts. The average 12-month price target is a stunning $194.07, but targets range all the way up to $250. That implies a potential upside of 24.35% from today's price. The bulls are driving the narrative, armed with the data, HBM dominance, the US manufacturing moat, and unparalleled execution. The market's lingering skepticism gives patient investors the entry point. Now for the risks. No stock is a sure thing. Micron still operates in a capital-intensive industry, meaning they have to spend huge amounts, $13.8 billion in 2025, to keep up. If demand slows, this high capex is a drag. They face relentless, well-funded competition from Samsung and SK Hynix, who are constantly trying to leapfrog them technologically. There's also concentration risk. A major customer like NVIDIA represents significant revenue. Any sudden shift in AI architecture could impact Micron hard. However, the mitigation strategies are built in. The high-margin HBM acts as a powerful revenue stabilizer. The $6.4 billion CHIPS Act funding de-risks capital expenditure. And their technological leadership is backed by $4.9 billion in annual R&D. Micron Technology has moved from the memory basement to the AI throne room. They have the technology, the profitability, and the geopolitical backing. Based on my analysis, it is a great stock. Do your own analysis before taking decisions. That is our deep dive into Micron Technology. What do you think about their AI pivot? Is the 50% margin sustainable? Let us know in the comments below. If you enjoyed this detailed analysis, please hit that like button and make sure you subscribe to Zalwora for more videos. For the full detailed report, including all technical tables and source links, check the link in the description below. Thanks for watching.